Hey there, welcome. Today we're diving into one of the most important topics for anyone just starting out with investing, avoiding the mistakes that can cost you more than just money. If you're new to investing, you might think it's all about following the latest tips on social media or waiting for that perfect market moment. Most beginners believe that investing is a game of chance or that you need intricate strategies to succeed. But here's the truth. Successful investing is really about avoiding a handful of common mistakes and keeping things simple. I'm here to share with you what I've learned along the way from my own experiences and working with countless beginner investors. I once made many of these same mistakes, investing impulsively, chasing trends, and panicking at every market dip until I learned the strategies that turned my financial journey around. Today, I'm going to walk you through 7 investing mistakes many beginners make and, more importantly, how you can steer clear of them so you can start building a secure, growing portfolio. So, let's jump right in. Mistake number 1. Investing without a plan. One of the biggest pitfalls for novice investors is diving in without a plan. Imagine setting out on a road trip without a map or destination in mind. You're likely to get lost or end up somewhere you never intended. Many beginners invest simply because they see inspiring headlines or hear that their friends are making money. But without a clear financial plan, you risk making impulsive decisions that might not match your long-term goals. I remember when I first started investing, I was so excited by the idea of making quick gains that I jumped into stocks without considering what I was really investing for. I didn't think about my risk tolerance or the amount of time I could hold the investments, and it cost me. The solution is simple: sit down and define your goals. Ask yourself whether you're saving for retirement, a down payment on a house, or something else entirely. Once you know your destination, use that as a guide for your investments. Tools like robo-advisors can help you create an investment plan that aligns with your needs. Mistake number 2, trying to time the market. We all wish we could predict when the market will be at its lowest so we can scoop up bargains, or conversely, know when to cash in on our investments. The common belief is that you can time the market to make a fortune, but the reality is very different. Even seasoned pros find it nearly impossible to predict market highs and lows consistently. I once sold some of my stocks during a downturn, thinking the market would drop even further, only to watch it bounce back in a matter of days. That experience taught me the critical lesson. It's not about trying to catch the perfect moment, but about staying invested for the long haul. Instead of worrying about perfectly timed entries and exits, consider using a strategy like dollar cost averaging. By regularly investing a fixed amount, you take advantage of market fluctuations without the stress of market timing. Mistake number 3, lack of diversification. Another common trap is putting all your money into a single stock or a narrow sector. Imagine investing everything you have in one company. While that company might be amazing today, if it hits a rough patch, you're left with a big loss. Diversification is about spreading your investments across different asset classes, stocks, bonds, real estate, and various industries. This approach helps cushion your portfolio against the volatility of any single investment. There's even ancient wisdom on this. In Ecclesiastes 11:2, it's written, "Invest in 7 ventures, yes, in 8. You do not know what disaster may come upon the land." This verse reminds us that spreading our risk is a timeless principle. If one part of your portfolio struggles, the other parts can hopefully make up for it over time. A helpful way to start diversifying is by investing in index funds or ETFs, which offer broad exposure with minimal fees. Mistake number 4, emotional decision-making. Investing isn't just about numbers, it's also about controlling your emotions. Many beginner investors let feelings like fear or greed drive their decisions. You might feel an adrenaline rush when a stock is soaring and rush to buy it, or panic when the market dips, leading you to sell out of fear. This emotional back and forth can lead to buying high and selling low, the worst outcome for any investor. I've been there, feeling the pressure when headlines scream doom, only to see the market recover shortly thereafter. The key here is discipline. Stick to your investment strategy and avoid making swift decisions based solely on short-term market fluctuations. One practical way to combat emotional investing is by setting predetermined rules like automatic investments or stop-loss orders, which help guide your actions during volatile periods. At this point, if you're finding these tips helpful, please take a moment, hit that like button, and don't forget to subscribe to help us reach 1,000 subscribers. Your support means the world as we continue to share these actionable insights. Mistake number 5, ignoring fees and costs. It's easy to overlook the impact of fees when you're excited about building a portfolio. However, high fees from mutual funds, brokers, or transaction costs can eat away at your returns over time. Many beginners don't realize that these fees, although they might seem small at the beginning, can significantly reduce your overall gains, especially if you're trading frequently. Imagine that you invest in a fund with a 2% expense ratio. While 2% might not seem like much over the long term, this fee can drastically reduce your net returns. The solution is to do your homework and compare the costs associated with different investment options. Look for low-cost options like ETFs or commission-free brokers, and always be mindful of the expense ratios and fees attached to any investment product. It's a simple adjustment that can make a big difference in your investment growth over the years. Mistake number 6, overconfidence and lack of research. Many beginners fall into the trap of overconfidence. They rely on a hot stock tip from a friend or trust a hunch without diving deep into research. Overconfidence can lead you to make uninformed decisions that might seem promising at first, but come with hidden risks. I've seen it happen time and time again. Investors buy into the hype without understanding the underlying fundamentals of a company. When I was starting out, I once invested heavily based on a glowing review from a blog, only to later discover that I hadn't really dived into the company's financial health or market position. The remedy is simple: always do your own research. Look into any company or fund you consider, understand its financials and business model, and consider what experts and reputable sources say. Rely on trusted resources and never be afraid to ask questions. There's no substitute for being well informed. Mistake number 7, focusing on short-term gains. The lure of making a quick profit is undeniable, especially in today's fast-paced online world. However, chasing short-term gains often leads to risky behavior, like investing in volatile, hyped-up assets such as trending cryptocurrencies or hot stocks in hopes of instant wealth. This approach can result in significant losses if the investment doesn't perform as expected. I've heard many stories from friends who, driven by the promise of quick returns, jumped into speculative investments only to face harsh losses once the hype died down. The key difference between sustainable investing success and a failed attempt lies in your time horizon. Rather than trying to jump on rapidly fluctuating opportunities, focus on building long-term wealth. Invest in diversified, stable options and let time work its magic through compound growth. Remember, wealth built over many years is much more reliable than a quick buck that might vanish overnight. Investing isn't a sprint, it's a marathon. By avoiding these 7 mistakes, you're giving yourself a solid foundation for long-term success. It's important to remember that every investor, even the professionals, makes mistakes along the way. What really sets you apart is your willingness to learn, adapt, and trust a plan that's been proven to work over time. There's an old proverb that goes, "Slow and steady wins the race." And it rings especially true when it comes to investing. With a clear plan, diversified portfolio, disciplined mindset, and informed decisions, you'll be better equipped to navigate the ups and downs of the market. Today, we covered the 7 investing mistakes that every beginner should work to avoid. Investing without a plan, trying to time the market, lacking diversification, making emotional decisions, ignoring fees and costs, overconfidence without proper research, focusing on short-term gains over long-term growth. Each mistake carries lessons drawn both from modern investing wisdom and timeless advice, even echoed in biblical verses like Ecclesiastes 11:2. The idea of spreading out your investments isn't just a modern strategy. It's ancient wisdom reminding us of the importance of preparation and diversification. Before we wrap up, I want to remind you, if you enjoyed this video and found these tips helpful, please hit that like button and subscribe. Let's work together to reach 1,000 subscribers. Your support helps us create more content that empowers you to take control of your financial future. Remember, investing is not about getting rich quick. It's about making well-thought-out decisions and consistently putting away a little bit of money over time. With discipline, patience, and the right information, you can avoid these common pitfalls and set yourself on the path to financial freedom. I hope you take these lessons to heart. There's no need to rush. Great things often take time to build. Let these strategies guide you, and you'll likely find that over time, the compound effects of your smart choices can lead to significant growth. Keep learning, stay curious, and continue educating yourself about the world of investing. Thank you for watching and joining me on this journey. Here's to making wise decisions and achieving your financial goals one step at a time.